Hi, welcome to this web broadcast covering YCharts 1% Focus Report on Intel. My name is Eric Kobayashi Solomon. I'm the Director of Research at YCharts. None of what I am going to say today should be construed as giving investment advice. Okay, let's take a look at what the agenda is for today. First, I want to talk a little bit about Intel as a company, its history and its present. Then I'm going to take a look at modeling and using YCharts Excel add-in for financial statement analysis. Then we'll use what we know about Intel and work at analyzing Intel's valuation drivers. When you think of Intel, you probably think computer chips. When I think of Intel, I think of Tyrannosaurus Rex. Turns out that, like Tyrannosaurus Rex, Intel is almost perfectly adapted to compete in its environment. It is the apex predator of the chip world. And the similarities between Intel and Tyrannosaurus Rex are not only in the fact that they're both vicious competitors and the strongest in their environment, but also that they have notable weaknesses. In fact, this Tyrannosaurus Rex has a problem with a tablet computer. You can't plug that in. And in fact, Intel also has problems with tablet computers. We'll talk about that in just a moment. Let's talk a little bit about specialization, because the specialization in the computer industry is what really helped Intel develop both its strengths and weaknesses. So in the very early days of computing, a computer company would make everything, take every step in the computer computer manufacturing process, and do it in-house. This included making its own chips, making the equipment that would make the chips, writing the software, putting together the device itself, and then marketing that to some other company as a client. However, as time went on and the industry matured, each of those steps in the computer production process became niches of their own, and a single company, or a group of companies sometimes, concentrated on just that bit of production. Now, an important thing to realize is this could not have occurred without some standardization of the platform itself. And in fact, the Wintel platform, this PC, kind of commoditized PC device that people know about now, had these kind of dual pillars, Windows operating system and Intel chip, so we call it the Wintel platform. It's really a standardized platform for for computer development. Now, this specialization did some great things for the industry and great things for these companies, but there were also some weaknesses. So let's take a look at both the strengths and the weaknesses of this extreme specialization. So basically, in a nutshell, the bullet points on this page could be described under the blanket term efficiency. We've got a standardized product. That standardized product is well known in terms of how it works, how the software works, and so other companies are willing to build upon that platform. As more companies build more products geared to that platform becomes more attractive, so it appeals to the masses. Now, mass production can only be done by a very efficient operation, and so this, as more and more people got interested in buying computers and they became mass-produced items, each of the steps, each of the companies involved in each of the steps on that value chain became very efficient at what they were doing. Now, The other thing that this specialization and the standardization of the platform did was to allow very tight development cycles for the computers. Gordon Moore, the founder of Intel, one of the founders of Intel, made the observation back in the 70s that in general, the industry had been able to increase the number of transistors on a piece of silicon by about a factor of 2 once every 2 years without increasing the production cost. This became known as Moore's Law. And I've written here Moore's Law treadmill. It really became a treadmill for the companies in this industry. I guess the computer industry kind of took Moore's Law, Gordon Moore's observation, as a challenge, and really worked very hard at increasing the transistor count for chips. And by increasing the transistor count, basically what you do is increase the power of the computer. So the computer industry worked very hard on doubling the transistor count once every 2 years. So once every 2 years, you're essentially recreating the way the computer works. Really, one of the pillars of it, the chip, is changing in a very real sense. We'll discuss later, Intel has always been the best computer chip manufacturer, the best at keeping up with Moore's Law, which gives it an advantage once every 2 years. Now, specialization bred this efficiency, which is a good thing, and created companies that were very strong at one type of production. However, it also created some weaknesses. Let's take a look at those. So these weaknesses could generally be described under the blanket term lack of flexibility. The computer companies were very focused on this Moore's Law treadmill, renewing the product once every 2 years, both with new operating system from Microsoft, new chips, peripherals stopped being such a competitive point. But basically, a PC was substantively changing once every 2 years. And the computer companies themselves failed to realize after a certain point that the computers were actually more powerful than the people who were using them really needed for kind of their daily life. You only need so much computing power to balance your checkbook. But even once there was sufficient computing power, the PC value chain, the Wintel ecosystem, was geared on making more powerful computers, so kept doing that. Now the other thing, and this will become an important point later as we talk about portable devices, evolutionary changes were valued over revolutionary ones. What this means is when you're on the Moore's Law treadmill, when the product cycle is so fast, once every 2 years, you really don't have time, an engineer does not have time to go back and reinvent the wheel. You've got a chip, and you've got an architecture design for it. You want to increase the functionality of that design. You're not going to go back and think about, could this design be improved in a fundamental way? What you're going to do is try to figure out how to stuff more transistors on that piece of silicon. So we'll see later that this became a real weakness for Intel. And in general, when you have such a specialized system, you wind up with a system that is open to shocks. Let's take a look at a couple of the shocks that have hit the Wintel ecosystem over the last 10 to 15 years. First shock was this transfer, the shift from floppy disks to flash. Now this didn't hurt Intel. It hurt some of the storage companies that were specialized in making this physical storage, the spinning media, companies like Seagate. But it did not hurt Intel. And another important thing to realize is that Seagate is still a company right now. It suffered from some business problems for a few years, but it's kind of reached a sort of a stasis again. So even though it was a shock, the move to NAND flash was a shock, it was not a fatal shock to this company. Another big shock to the Wintel system was a shift in consumer demand from desktop computers to laptops. Again, this did not affect Intel. In fact, not only it didn't negatively affect Intel, but it actually kind of positively affected it, because the laptop computers were more efficient and ran a lot better with the newer chips, and so Intel could sell kind of its newest cutting-edge chips relatively easier because it was selling into the laptop market. However, this shift from desktops to laptops did hurt some firms, specifically firms like Dell and Hewlett-Packard. IBM completely got out of the PC business early on in the game, which worked out to be a really smart move. And these computer companies could no longer kind of compete on customization of the components that went inside one of these large desktop boxes. When you have a laptop, you have much less room. You have to have a kind of a standard configuration. And so companies like Dell that had really built a business on customer customization were not able to do that and have had a lot of problems kind of coping with it. While it's had a lot of problems, it still exists. It was taken out in an LBO. HP has had some problems, but the system hasn't collapsed, in other words. Now the last the last switch, or the last shift for the Wintel system, the most recent one, has been this shift towards mobile computing. I don't know if you recognize the device on the left of the screen here. That's actually an Apple Newton made in the mid-1990s. It did not meet with business success, probably because the internet was very young at that time, and connection speeds were not good. There was not a wireless connection. But a lot of the engineering that went into producing this Newton actually ended up helping the designers of the iPhone that you see there on the right. And it was really the iPhone and the iPod before that which changed the way people thought about computing. If you think about an iPod, it is a computer, a very simple computer. It can't do very much. It's the original iPods were just a hard disk drive connected to a specialized chip that would translate digital signals into audio signals. This is a very different kind of computing than the chips that Intel had always specialized in. It was not a generalized chip. It wouldn't calculate very quickly. What it could do was a specialized task very efficiently. Now, as the iPhone was developed, as wireless computing or wireless connection speeds became better, gradually the locus of computer power shifted from the devices that people were using towards a server, a data center somewhere. These handheld devices didn't have to be smart. Now remember that Intel specialized in making smart chips, very powerful chips. And so this shift away from the device towards a server was one that was a fundamental change in kind of computing. Now, Intel was not destroyed by this because you still need a smart server somewhere. 97% of the servers in the world are running on the Wintel platform, Intel chips, whereas 97% of the handheld devices are actually operating on designs from ARM Holdings, a British company. And these ARM Holdings designs tend to be more power efficient and but much less powerful in terms of processing power. So Intel faced this shift towards mobile computing. Um, Revenue growth has flagged a bit over the last few years because of this, but it's also important to realize that Intel has not been destroyed. And this says something important about the Wintel ecosystem. People think, could handheld computing mean the collapse for Intel and for this Wintel ecosystem? The one important thing to realize, there are two important points. One of the important things is that systems theory that can be used to talk about these kind of ecosystems says that systems favoring specialization, like the Wintel system, are very stable. They don't tend to collapse easily. They tend to keep going for a long time, and they can adapt to small changes or even pretty big changes, um, maybe with some evolutionary difference in the participants. However, that said, specialized systems do have a tendency to collapse all of a sudden when faced with a large structural shock. This is something like the collapse of the Soviet Union. You can see this very clearly. My personal belief is that the Wintel ecosystem is robust enough to survive this move towards handheld computing, but that will need to change, and Intel as a company will need to change some aspects of its business strategy in order to succeed in this new world. Let's take a look and kind of sum up what we know about Intel by looking at a SWOT analysis. SWOT analysis describes the strengths, weaknesses, opportunities, and threats to a certain company. Under the strengths category, Intel can't be emphasized enough how strong it is in terms of chip manufacturing. As I was saying before, Moore's Law said the Moore's Law treadmill, basically once every 2 years, chips that were doubly as powerful, twice as powerful as previous chips were able to be produced. Intel was always at the leading edge of this Moore's Law treadmill. It was always able to put chips out a few months ahead of competitors. This gave it a first mover advantage once every 2 years in this industry that was recreating itself that quickly. It's an enormous advantage. And their engineering capabilities are really second to none. Now, the weakness we've alluded to earlier, the fact that Intel really does not produce energy efficient chips, and the root cause of this weakness goes back to some of the strengths and weaknesses that we discussed when we were talking about specialization. Intel, you'll remember, was very good at making evolutionary changes to its chip designs, but the core chip design was basically the same. Indeed, at present, Intel is building chips that are based on kind of a 1980s architecture, and they're just building them more efficiently. They're putting more transistors on, they're putting more cores on the chip, but these mid-80s architecture chips have implicitly assumed that there's going to be an AC power source, and that the consumer that wants these chips are going to want more and more powerful chips. The trend for chip manufacturing now for devices is actually towards less powerful, more energy efficient chips. And simply because Intel has been very good at evolutionary designs, it's not good at producing these kind of chips. Now, if we turn and look at opportunities, I think that the foundry business does present an opportunity to Intel if it can make the kind of cultural shift necessary. A foundry is a third-party manufacturer of chips. Pure Play Foundry is Taiwan Semiconductor. That's the largest and best pure play foundry in the world. There are also hybrid foundries. An example of this is Samsung, where some of the chips that they produce under their own brand and under their own design, and then some of the chips that they're producing are produced according to the designs of a third party. So Intel would probably take that hybrid approach. The problem with that is that Intel has been very good at producing chips. We already know that from the strengths part of this analysis. However, it's not clear to me whether or not they are going to be good at the give and take that's required between a foundry and a chip design firm. These chips are incredibly miniaturized. The features on a chip are incredibly miniaturized. It really is, to produce them, pushes the bounds of engineering. And so there's always a give and take between the designer and the manufacturer. And Taiwan Semiconductor has become very good at kind of balancing the engineering necessity versus what the designers exactly want. I'm not sure that Intel will be able to do this. It'll be a big shift for the company to go into foundry business, but its new CEO is talking about doing this in a bigger way. They've tried this in the past, hasn't been too successful so far, but I think that this is one opportunity for Intel going forward, and an opportunity for it from the standpoint of it would allow Intel to profit from a shift towards mobile chips in a bigger way than it has been able to so far. Now, in terms of threats, I think there's kind of a more important threat and a less important threat. The more important threat is actually a possible death of Moore's Law. A few knowledgeable observers, including Gordon Moore himself, are starting to say that it looks as though we're kind of bumping up against physical constraints, that we won't be able to keep on that Moore's Law treadmill going forward. What this means is that the first mover advantage that Intel has always had in the past is not going to be there. And this means that Intel will have to compete on the basis of greater efficiency, maybe on the basis of its foundry services or something like that. But if Moore's Law, in fact, does start to collapse, Intel's business environment is going to change. The other thing is this attack on the server market. Now, big companies that use a lot of server power, like Google or Amazon, for these companies, energy efficiency is becoming a big issue. They've got so many servers that the amount of energy it takes to power those servers and to cool those servers is really material. So an idea has come up that they could use ARM Holdings chips. Remember, these are the chips that go in mobile devices that are less powerful but more energy efficient. Could use these in servers and have a more energy efficient server. These devices have just started to be marketed. They haven't been terribly successful or gained a lot of traction in the market yet, but it is possible that Intel's market share in the server world will be under attack over the next couple of years. To me, I think that the death of Moore's Law is a more important threat, but this is, the server market challenge is one thing that a potential investor should not ignore. All right, now that we have a framework for thinking about Intel, let's move on and talk about modeling, and I'll show you the template that I use to produce the 1% reports, and then we'll do a bit of a valuation, kind of a simplified valuation using what we know and this Excel template. So first, let's talk a little bit about principles of good modeling. I've done financial statement modeling quite a lot for the last few years. I was even hired by the World Bank to design and build a standardized valuation template for their emerging market private equity holdings. And so I've done a lot of thinking about what good modeling is. I've come up with 3 principles. First thing that I think is important to realize is that data does not give the answers to an investor. What it does, it points to the right questions to ask. We'll see what I mean by this when we take a look at the spreadsheet. Another thing that is important is that complexity breeds confusion. In fact, if you're familiar with the J.P. Morgan London whale debacle, where J.P. Morgan lost several $billions, one of the reasons that it lost that money was that the spreadsheet that the trader had built to tell him which fixed income derivatives to buy and sell had an error in it, but the spreadsheet was so complex that no one spotted the error until it was too late. So I firmly believe that simple is better when it comes to modeling. And Warren Buffett's advice that it's better to be 80% right than 100% wrong. In other words, you lose a lot by trying to become very accurate in your modeling. It's better to model kind of broad brush, 30,000 foot level kind of things. Then the last thing, which I think is important, is to concentrate on a few drivers and to really understand their dynamics. Of course, if you're focusing on having a simple model, it makes sense that you should only concentrate on a few things. Let's take a look at the things that are important to focus on. The 1% reports are set up with a particular bias, a particular assumption about how the world works. That is, that the value of a company is the sum total of the cash that that company will create on behalf of its owners over the company's life. We're assuming that the company's life is perpetual, the company will last on and on into the future, and that its worth is exactly the amount of wealth or cash that it creates on behalf of its owners. Now, if you accept this definition and if you accept this kind of theoretical framework, you'll have to realize that there's only a few things that can generate cash for a company. First, the company has to sell something that people want to buy. It has to generate revenues. After that, it'll pay some direct costs, it'll pay some costs to maintain the company, and after paying this cost, it will generate a profit. And these are the first 2 drivers of valuation, revenues and profits. I talk a lot more about this in the valuation methodology section of the 1% reports, and I also have recorded a webinar which we'll have up on the site pretty soon that talks about this valuation methodology. So this owner's cash profit is actually a bit of jargon that I've developed myself. I'll talk more about what the definition of that term is in those other resources. So we've generated revenues. We have converted those revenues into profit. Now, a company can now choose to just return all of those profits to the owners. In this case, the free cash flow that the company is creating goes directly to the owners. And so this is the profit is the cash flow that will end up valuing the firm. I call the cash flow that we're measuring to develop our idea about the value of a firm free cash flow to owners. In this case, the free cash flow to owners is exactly the same as owner's cash profit, and so it's very easy to measure. Now, for Intel and for a lot of other companies, the company management does not return all the cash to owners, but rather makes investments using that cash. And when a company makes investments, that means that the amount of free cash flow available to the owners is actually less than the profits. And you might think that this is a bad thing. However, if the managers are good at making investments and if the investment environment is very rich, then it's actually a good thing because future profits will be much greater. If a company has great opportunities to invest profits and it doesn't invest those profits, an owner should be disappointed. That means that the future profits won't be as great as they might be. So this investments, the level of investments that a firm is making, and then its efficacy, its actual, whether or not the investments a firm makes are generating growth in the future, this is the third driver of valuation at a firm. We've got revenues and profits, and revenues and profits tend to be easier to forecast on a short-term basis. And then we've got this investment level and efficacy, which tend to work kind of in the medium term. You make an investment today, you don't know the results of that investment for a couple of years, and so in our valuation methodology, basically the investment efficacy is controlling growth in the medium term. Okay, now that we have an idea about how we're going to think about modeling, and we know what we're going to model, let's actually turn to the 1% template to model Intel. Okay, here we see the model that I use for the 1% focus reports. You can see here that the ticker is set to Intel, INTC. I'm actually showing you a model that is not live. In other words, it's not connected to the YCharts database. If this were a live model, all I would have to do is change the ticker and would be able to pull back data about another company. So here on this first tab, I just have some numbers which are important to me regarding the market capitalization, kind of how much sales and cash flow it's generating, and some information about the value score factors. I have also set up a tab that allows me to take a look at how Intel compares to other companies. Here I've put in tickers for some of Intel's competitors, and I can take a look up here in the first two tables. This is allowing me to take a look at a DuPont decomposition. You'll see these tables in the 1% focus reports as well. Down here in the bottom, I have some other measures that I think are important about kind of how much cash flow it's creating, change in net working capital, and some of these ratios. And so this is a really nice way. Again, all I have to do is type in a new ticker, and if I'm working with a live model, I can very easily take a look at that company and the industry. The YCharts Excel add-in also allows a user to bring back prices. And so here I've got a price chart with the S&P versus the focus company, in this case Intel. And we can see that Intel has been pretty flat for a few years. Now the main tab that I use to analyze companies is actually this FSA data tab. FSA just means financial statement analysis. You can see before, one of my principles of modeling was to keep it simple, and to concentrate on a few drivers. Indeed, I only have a few drivers that are going to be the real focus points of my analysis. We've got revenues and cash profits, which we talked about as the two short-term drivers. And then we've got free cash flow to owners as kind of the third big thing. And then I've got a note there about the expansionary cash flows as well. Again, all of these numbers are drawn from the database just by changing the ticker. You can see that I have also included, and all I have to do is expand out or contract each of these little sections. But I've also included some, let me make this a little bit bigger so it's easier to see. I've also included some summary statistics, year-over-year change, change in 5-year rolling aggregate of revenues. We'll talk about that in a minute. Owner's cash profit margin down here. So here I'm looking at how efficient the company is in generating profits out of its revenues, and then taking a look at the different parts of what I call expansionary cash flow. This is basically the money that the firm is spending on investments to make profits grow more in the future, to come down to get the free cash flow to owners measure. Now, if we take a look here at the free cash flow to owners, I like to look at this free cash flow to owners margin, and we can see, we can kind of start getting a sense for generally how much cash flow does this company generate as a percentage of revenues. That's what this margin number is. Now, to be able to do this over a longer period of time, I've also calculated some longer term statistics here. One of the things that I'm looking at is how much of the profits, the percentage of the profits that the company is spending on these investments. And for instance, in this case, I've taken a look at the median of this for the last 10 years. See, this is 10 years worth of data. Oops. And I can see that the median value is about 44%, max value is about 66%, and down to 25% on a minimum. This is going to inform our ideas about kind of what the firm does on a normalized basis over a cycle. And I look at this for each of the drivers, revenues, profits, and then of course the free cash flow. Now, if you're like me, looking at just a string of numbers is not terribly helpful. You can see that I've got a graphing data section here where I've figured out what I want to see and set up the spreadsheet so I can pull that data easily. So all of these graphs are saved on this page. This is the display charts. So let's take a look first at revenues and see what we see in revenues. Now, recall that I said one of the principles of good modeling is that data won't give you the answers, it'll tell you what questions to ask. And so as I look here at this revenue chart, what I've got here is kind of a high water mark for revenues over a 5-year period, low water mark for revenues over a 5-year period. This smooth blue line is this rolling 5-year aggregate change, which I use this rolling aggregate. Preferentially, it is not nearly as noisy as the year-over-year numbers. Here you can see the year-over-year numbers really bouncing around. And it also doesn't have weaknesses regarding starting level that compound annual growth rate has. So as I'm looking at this chart, you can see that it had a very quick period of growth here in the mid-90s, So the first thing that I want to do is make sure that I understand why revenues were growing so quickly during this period. Here I see a big drop in revenue growth down to negative 20% in 2001, so I want to know what that is. And in general, what I'm looking for here are these big kind of um, outliers, uh, large movements that attract my attention. I want to figure out why the revenue is coming into the company. And so I'm going to look, for instance, in recent history, this 24% year over year increase in 2010. Well, it turns out that researching that, uh, we had a couple things happening. First, a lot of companies held off making purchases of servers in 2008, 2009 because of the financial crisis. So you got a lot of rebound demand coming out of that period. And you also had more consumers overseas in developing markets wanting laptop computers, let's say. So you got some boost from increased demand and new demand. In 2011, I see another 24% year over year increase, and notice that there is a big acquisition. So this prompted me to take a look at this acquisition. It turns out that it's most of that is an acquisition of McAfee. I talk more about this in the report. I don't think that McAfee was a great acquisition for the firm, but it did succeed in making revenues grow. Now, if we look at this 5-year, year over year average, rolling aggregate sales increase, we see about a 7% increase. And it looks like actually that is not a bad estimate for how fast sales increase over time. Sometimes it's a little faster than that, sometimes a little slower, but somewhere in that kind of mid-single digit range is probably reasonable to expect. So when we take a look at the valuation, we're going to take a look at kind of what a best case is, a worst case is, and what a most likely case is. And so probably my revenue growth assumptions are going to be somewhere in that mid single digit range. Okay, let's go down to take a look at the next thing, which is owner's cash profit and owner's cash profit margin. And here again, the thing that really jumped out to me were these plateaus and mountains. I've labeled them A, B, and C here. You can read more about this in the report. The thing that I noticed was first the existence of these kind of mountains. They're very notable. We have distinct periods of increase in profits and then a sudden decrease. So we see a cycle. We also note that trough margins and peak margins are pretty well defined. If you had to make a guess about trough margins, I would say mid-teens percentage somewhere, looks like. If I had to make a guess over peak margins, I would say kind of mid-20% range somewhere, which is basically what we've got here. So this also informs me and gives me an idea of what numbers I should put in when I think about the valuation. Now, the important thing is that I'm not just blindly taking a look at the historical numbers and plugging those into the valuation model. I'm understanding what's happening with these profits and thinking about, in terms of what I know about Intel's strengths, weaknesses, opportunities, and threats, what I could expect from Intel in the future. Now here I'm looking at the growth in owner's cash profit, and this green line again is the 5-year rolling aggregate number. You can see it's much less bouncy than this blue line, which represents the year over year change. The very interesting thing to note here is that this ending value for the 5-year rolling aggregate is 13%. Now, if you remember, the ending value for revenue growth was 7%. So Intel is able to generate quicker growth in profits. In other words, they're able to generate efficiencies, operational leverage, as they are increasing the amount of products that they sell. This is also very important in understanding kind of where the firm is going and indeed how successful its investments have been. This is, and we'll see in a moment, a chart where I'm taking a look at the growth in OCP versus the growth in gross national product to get an idea of how fast Intel is growing versus other companies in the economy. Here we've got net expansionary cash flows. These again are the investments that the company is making. Here's this 44%, the median value. And you can see that even though this is the median for just 10 years, it looks like that median has existed for a long time. I mean, that it's a pretty sticky number, in other words. It looks as though that 44% number is not a bad assumption for what the company has to spend on investments. Now, again, this is only an historical measure. We have to think about our SWOT analysis and remember back that maybe Moore's Law is starting to fail. If that's the case, they may have to spend more on these investments, the investments to produce new chips in the future. So maybe a reasonable worst case scenario would see them spending more money on investments. This chart I talk about in the 1% report. It's where their investment dollars are going. This is the report, the graph that I mentioned earlier. How fast is Intel growing its profits vis-a-vis US GDP? You can see that they're growing on average. It looks like, we've got a couple of these downturns, these cyclical downturns, but in general, it's able to grow about as fast as the economy at large over the entire cycle, and maybe a little bit faster than that at peak times. So this will inform our idea about medium-term growth. Here we've got our free cash flow to owners chart, just showing these blue bars are the free cash flow to owners. These dark blue bars are owner's cash profit. And then here we've got margin, black, and the growth in green. And these are also going to inform our ideas about valuation assumptions later on. Let's go ahead and turn to the valuation assumptions. And going back here to the Control tab, now we're going to take a look at the right-hand side of this tab. Now remember, I took some historical estimates or historical statistics about each of the drivers of valuation, and I've linked those statistics to this area of the chart here. Now what I've done is I've put in some values for likely, worst, and best case values for each of these drivers. I've based it on the historical numbers. In fact, for these reports, I make an attempt not to make any grand assumptions about this business. I'm going to basically do just kind of a standard, let's say vanilla valuation of this company. And what I'm using here is what, informed by historical trends, what are my assumptions for future values for these numbers. You can see kind of where I am sitting in terms of my assumptions for revenue growth, my assumptions for growth in, or rather for profitability. You can see that my band here is a good bit tighter than the historical statistics band. And then percentage of expansionary expenditures as a percentage of profits. You can see my worst case scenario, as I mentioned earlier, Moore's law starts to break down, and so Intel will have to start spending more money on developing chips. Best case is maybe a little bit less than they've spent in the past. Maybe this is if they move into foundry business in a bigger way and don't have to spend as much developing new chips. And then medium-term growth assumptions. Here, a number that I always think about is the growth of US GDP. Historically, that's been about 6%. What I'm saying here is it's likely that their medium-term growth will be about the same as US GDP. Worst case, they will fail to grow as fast as US GDP in the medium term. Best case, they'll be able to grow about at the rate that they're growing now versus US GDP. And here we've got the stage 3 assumed growth rate. This is the long-term growth. So remember that we're valuing a firm on the basis of a perpetuity. So this means it'll grow cash flows at 6% into the future. And I'm also discounting those cash flows at a rate of 10%. I talk more about why I use these assumptions, discount rate assumptions, and growth rate assumptions in the valuation methodology section of the reports, so please take a look at that. Now, after all of these assumptions are input into the model, what I come up with is a valuation chart like this. What I've got here is, you see this dark line, it's the actual cash flows of Intel, the free cash flows of Intel over the last 10 years. And each of these dotted lines represent the worst case free cash flow amount, the most likely case, and the best case for each year in the future. And I'm taking this analysis out 95 years, I think, 100 years maybe. What I'm trying to do is get some stability in these numbers, which are the discounted amounts. As these, of course, the actual cash flows keep increasing, but if you discount these cash flows, they begin to level off at a certain place. And these leveling off places indicate what the intrinsic value estimate under different scenarios is. Here I've got the most recent market capitalization, about 123 billion. Most likely capitalization using the assumptions that I'm using now is about 146 billion. Best case is 206 billion, and worst case is here around 75 billion. Now, obviously, these are not per share numbers, but overall market capitalization numbers. Going back to my control sheet, you can see the most recent market price, and then each of those best case, median case, and worst case share price numbers represent the market capitalization from the graph I just showed you, divided by the number of outstanding shares. You can see about 19% increase forecast to the median case valuation, almost 70% to the best case, and about negative 40% to the worst case valuation. So hopefully this will give you as an investor an idea of where you think, kind of which scenario you think is most likely for this company and where that lies along this valuation scenario spectrum. Okay, so that does it for this presentation today. Thanks very much for tuning in, and if you'd like to know more about these spreadsheet tools that I've been using to produce the 1% reports, please do follow that URL on your screen, or feel free to drop the guys at the sales team a note and ask them for some information about this. Also, if you have any questions about the companies or the analysis that you see on the YCharts site, my email address and contact information is on those reports, so feel free to send me any questions. Thanks very much for tuning in. Looking forward to talking to you soon.